Welcome to the discussion. Today we're diving into a fascinating research piece from Fidelity Digital Assets titled A Closer Look at Bitcoin's Volatility. It challenges some common assumptions about Bitcoin's price swings.
Indeed. The prevailing narrative often paints Bitcoin as wildly unpredictable, but the research presents a more nuanced picture.
Exactly. It suggests Bitcoin's volatility might be less than many believe and even less than some established stocks.
That's right. The study compares Bitcoin's volatility to that of several S&P 500 companies, revealing some surprising results.
Intriguing. Let's unpack this. What were some of the key findings that stood out to you?
One of the most striking findings was that Bitcoin's volatility, while undeniably present, has been lower than that of many large-cap stocks, even some considered relatively stable. For instance, they cite Netflix as an example, where Bitcoin's volatility was lower over certain periods.
That's counterintuitive to the common perception. So it's not just about comparing it to broad market indices like the S&P 500.
Precisely. The research goes beyond broad market comparisons, delving into individual stock volatility. They found that Bitcoin's volatility was lower than that of 33 S&P 500 companies at one point, and even lower than 92 at another.
That's a significant finding. It really challenges the notion of Bitcoin as inherently more volatile than other established assets. The paper also discusses the trend of declining Bitcoin volatility. Can you elaborate on that?
Absolutely. The research highlights that as Bitcoin matures and its market cap grows, the impact of new capital inflows diminishes. Essentially, the same amount of new money has less of an effect on a larger market. They even draw a parallel to gold's historical volatility, showing a similar pattern of initially high volatility followed by a decline as the asset class matured.
So the expectation is that this downward trend in volatility will continue.
That's the implication. As Bitcoin becomes more established and widely adopted, its price should become less susceptible to dramatic swings.
The study also touches on investor perceptions of Bitcoin's volatility. What do they find?
Interestingly, they found that implied volatility, what traders expect volatility to be, has consistently overestimated realized volatility, the actual volatility. This suggests that investors may have been routinely overestimating Bitcoin's risk.
And what about the actual risk-reward profile? Does the higher volatility necessarily translate to higher risk?
Not necessarily. The research points out that Bitcoin's Sharpe and Sortino ratios have historically been favorable, indicating that investors have been compensated for the perceived risk. The Sortino ratio, which focuses on downside risk, is particularly noteworthy, suggesting that much of the volatility has been to the upside.
The paper proposes a model to understand Bitcoin's volatility regimes. Can you explain that?
The model links historical volatility to on-chain data, specifically focusing on the percentage of Bitcoin addresses in profit. They introduce the concept of seller energy, which combines the percentage of addresses in profit with realized volatility.
And how does this seller energy metric help in predicting price movements?
The research suggests that historically low volatility, coupled with high seller energy, high percentage of addresses in profit, has often preceded significant price increases. This is because, after a prolonged bear market, most selling pressure has been exhausted. When volatility is low, it suggests a lack of selling pressure, even with a high percentage of addresses in profit.
Are there historical examples to support this model?
Yes, the paper identifies several instances where historically low volatility preceded substantial price gains. They highlight that early 2024 shows characteristics similar to these past instances.
So the current low volatility might be a bullish signal?
The research suggests that it could be, but it's crucial to remember that past performance is not indicative of future results. The model provides a framework for analysis, not a guaranteed prediction.
What are some of the limitations or caveats of this analysis?
The most important caveat is that unforeseen events, like the COVID-19 pandemic in 2020, can significantly disrupt market patterns. The model is based on historical correlations, not causal relationships. It's one piece of the puzzle, not the entire picture.
So it's not a crystal ball, but a valuable tool for analysis?
Exactly. It provides a framework for understanding Bitcoin's volatility and its potential relationship to future price movements, but it shouldn't be interpreted as a definitive prediction.
In conclusion, this research offers a compelling counter-narrative to the often held belief that Bitcoin is excessively volatile.
It suggests that Bitcoin's volatility is declining, potentially less than many other assets, and that this volatility, when considered within a broader context, might even be a positive indicator for future price appreciation.
Thank you for this insightful discussion. It's clear that understanding Bitcoin's volatility requires a nuanced approach, going beyond simple comparisons and considering